I am very passionate about you getting paid, which is why we're going to talk about accounts receivable, not just today, but we're going to talk about it in a series of videos because I want to take my time and break it all down and focus on insurance based businesses, which I love to work with. Hey CEOs, my name is Nailea and I'm the founder of Sunflower Financials, and I help businesses turn confusing numbers into simple strategies that actually help improve your cash flow. And today I am talking about the foundations of accounts receivable, why it matters, how it's important to your budget, and what healthy AR looks like in your business. Now, I am going to be very specific and talk to you about insurance based businesses. They're a particular subset of clients that I like to work with, including ABA centers, speech and OT, physical therapy, chiropractics, whatever kind of businesses take health insurance. AR is your biggest asset and probably your biggest headache. So let's break it down. When you take insurance, you don't get paid immediately. You're providing services today, but your payment cycle is sort of out of your hands. And it could be as far out as 60 days or more, right? So it depends on the insurance company and the patient. Unfortunately, with AR, I'm going to go ahead and say you have to be pretty annoying, right, to get paid. And we can set up systems, automated systems, and set up policies and procedures that can make the system flow a lot more seamlessly. Accounts receivable is the cash flow of your business. You have to know when you're going to be paid to have the cash to pay your expenses. So your AR balance directly impacts how much money you can count on every single week, next month, next quarter. So you're forecasting your cash flow based on your AR. This is really important to know. That's why AR isn't just bookkeeping, it's a planning tool. So it helps you budget your payroll, budget your rent, supplies, and growth without being surprised or becoming short on cash. Here's where most businesses get in trouble. AR gets too high and then it silently eats away at your profits. And maybe you are taking out loans or credit lines to pay your staff and get your expenses covered, and then you lose sight of where your AR is. You're not keeping track of it and you're not having enough meetings or have somebody in charge of it. So what's normal? For insurance-based businesses, you should aim for less than 20% of AR being over 90 days over 90 days old. If more than 30% of your AR is sitting past the 90-day mark, then it's a big red flag and it means your collection system needs some attention. So ideally, the total days in AR would stay under 45 days. And if it's creeping into 60, 75, and 90, then you're really draining your business. And you're probably honestly looking for some funding to kind of cover costs. As you know, I like to look at specific numbers. So let's show you a few KPIs. I won't get into all of them. I'm going to do a series on this. So if you're liking this information, like and subscribe. And I'm going to do a few more videos on just AR for insurance-based businesses because I'm so passionate about this. But I'm going to share my screen and we're going to look at 3 numbers that I really need you to know in your business. Okay, core KPIs to track for insurance-based businesses. The first thing that I'm going to talk about is your 101. So days sales outstanding. The formula is the accounts receivable divided by total credit sales times the number of days. So the goal is to stay under 45 days for insurance heavy businesses. If you do not have someone in charge of AR in your business and you're just kind of hoping that people pay their bills, this is the time to rethink that position and put someone in that place. We shouldn't let, if you have time, then please check this out, happen if you're an insurance-based business. So we need someone to be able to calculate this formula and provide it for you on a weekly basis because you need to understand what's going on and be present with the cash flow that you need to make things happen, right? And make things grow. The next KPI is a percentage of AR over 90 days. Again, we just talked about how less than 20% should be the goal. If it's more than 30, then it's a red flag. This should be as simple as going to whatever software you use to accept payments and pull the AR aging report in that software. So many of my businesses don't realize that every single software you use, every vendor that you use has a reporting section. So find the reports section and pull the aging for your payments. So anywhere that whatever software you use, there's so many, I don't even know. I can't even mention them. There's just so many. You get anything that you use to accept payments, check the AR aging. So you've invoiced someone and they either have paid or they have not paid or they have partially paid, which is also an important piece to know. So there's no calculations here, just pull the report. And then finally, we want to look at the collection rate. So your formula is the payments collected divided by the payments billed. And it's that simple. If you're collecting payments and there is a lag of, let's say, 60 days, are you collecting 100% of those payments every 60 days? Are you collecting 95% of those payments? What a percentage of those payments are you collecting? Are you keeping the cash coming in even though your AR maybe is big, right? With insurance-based income, it can be pretty long, but if you have a good flow and the cash is coming in on time for you to pay your expenses, then maybe things are not so bad. So it's really important to understand 95% and up shows how much you're actually getting paid versus what you're getting billed. Okay, so we have some main KPIs. There's some more things like bad debt and whatnot, but I'll get into those in a next video. But one of the things that we want to make sure that we do is low-hanging fruit here is get into a reporting rhythm. So if you have a software that I know you do, to invoice people, go to that software and get the report. Get the reports, get to know them, understand them, and then start looking at them every week. Okay? You need a weekly AR review. This is a non-negotiable. You're going to look at the total AR balance, the percentage over 90 days, and the days outstanding. You're going to spot problems before they snowball. Then you're going to do a monthly deep dive. So you're going to review by payer, service type, and aging buckets. And then you're going to adjust your forecasts and budgets based on these things. So quarterly, then you're going to evaluate all of your policies, the reminders, the payment plans, and the collections, and you're going to set AR reduction targets. Reduce AR over 90 by 10%, reduce AR over 90 by 20%, whatever it is, you want to set some targets quarterly because if you don't have a goal written down, then it's just a dream. And the final actionable item that I can give you today is to have someone be in charge of AR, not whoever has time. So there's a couple things that you can do today for your business. Go get your AR reports, get to know them, look at them weekly, create a monthly deep dive. If you don't have policies and reminders and collections in place, then that's probably a little bit of a bigger project, but you want to start thinking about that and getting that done. And I'm going to dive into that in this series. So if this has been helpful to you and this is something that you're interested in, go ahead and subscribe and turn on those notifications so you don't miss the rest of the series. And drop a comment below. What's your biggest frustration with AR right now? I'd love to hear it. See you next time.